Welcome to today's episode of the MP Access podcast. I'm David Wharton, the editor-in-chief of Mortgage Point and the 5 Star Institute. Speaking to us today is Candace Russell from Carrington. Welcome, Candace.
Hi, David. Thanks for having me.
So give us a quick little elevator pitch of who you are and what you do. Well, you work with us a bunch, but tell us who you are.
You're going to reduce me down to the elevator pitch?
Yes, that's what I'm doing.
Well, I'm Candace Russell with Carrington Mortgage. I like to say that I do whatever they'll let me do, particularly focusing around government servicing, default servicing, and policy, government policy. So that's what I like to focus on.
Whether that's what you end up focusing on, it remains to be seen.
Yeah, it varies from day to day.
Well, I know we're speaking right now. We're working on our cover story for December, which is about prop pres sector and all the various things that are going on there. And I know you have been working with some of our groups and just working on and focusing on things such as the Commissioner's Adjusted Fair Market Value, which is a mouthful. Could you talk about a little bit about the role and importance of this within the FHA claims without conveyance of title process?
Absolutely. So CAFMV.
CAFMV, I don't know if that's right.
CAFMV, which we shorten it to and get it wrong frequently, is the originally intended to be a way to reduce payouts and conveyances for HUD. And it would do this by, particularly in the market it was considered in, with people being underwater, it would have reduced the claim to say a third party's come in and they are willing to pay 80%. And normally we wouldn't allow that. We want you to go up to your total debt. But considering it's underwater, why don't we allow them to take it for the 80% and then the claim will be reduced to the leftover 20%. HUD doesn't get the property and they pay out less of a claim. So that was the original intention of the rules. And it allowed for its exact purpose, which was less conveyance, which can be very expensive for HUD. And kind of hurts the MMIF fund, and then also reduces the actual claim payouts because it encourages third-party bidding to come in and take properties for the actual value of the property.
Could you talk about, I know there's been changes to this over the years. What are some of the most recent changes as far as how they are actually calculating this? What's going on there?
I think one of the reasons we'd be talking about it for the first time, and it was a program that existed before 2015.
Okay.
But in 2015, it switched over from being a more voluntary program, and they changed some features of it and turned it into a mandatory program that would parallel with conveyance. In a way, it was kind of whatever happened first, you would use that as your method.
Okay.
And the reason that they did this to see if they could indeed drop the REO amounts and have more third parties come forward and take these properties and hopefully get them to market quicker and have owner occupants in them. There's, a first look that at one point was involved. But I think the reason we're talking about it right now is not necessarily because there's been a change, but maybe because currently there's a question of interpretation.
Okay.
I'm not an attorney. I don't even play one on TV. So we're not going to speculate on that. But I will say the reason that we're talking about it is because we have, as an industry, done things one way for a very long time with the understanding that there was this kind of, you take the lesser of. Mm-hmm. So if you've got a total debt bid, and that's the lower number, you do that one. If you do the CAFMV based on the haircuts HUD gives you, you use that number. It's the lower of. And there's been some concern, maybe in an actuarial sense, that you are actually supposed to just use the CAFMV no matter what. And again, this would be for maybe some economists, statisticians to kind of go over what that looks like for a HUD actuarial table. Mm-hmm. But I think the hope would be that maybe, I think if we're looking at this in the best light it possibly could be, is if you bid that CAFMV all the time, maybe HUD gets paid out on their partial claims because it's bidding the value, and maybe the value is higher than the total debt. And if you've got a total debt plus a partial claim, maybe that payment could come out of this value from the home. It's not the exact way that I think the industry sees the program working or how we've worked it in the past, which is why we're having these discussions with everybody at the table, including, HUD, to say, is this really how we want to go? We think that there may be some concerns around implementing to this, and there's also not necessarily been a change. It came out in a reminder, which would indicate no change, just a reminder. And again, trade group wise, we're having these conversations about, is it a change? Is it not a change? So I can go on for a lot about that. But I would say in general, the reason we're having this conversation, the reason it's coming up at all is just because I think that there's the hope and anticipation that the market would have swung in such a way that perhaps this interpretation of the wording would have allowed for more benefit to the MMIF.
Are you seeing these changes impacting the way things are playing out with the bidding for foreclosure sales under the CWCOT program? Are you seeing more bids, tighter margins, faster dispositions, anything that's a general trend, or is it just kind of all over the place?
So I would say in general, the CWCOT program has been excellent. The CWCOT program is what you use CAFMV bidding for. I almost feel like we need to run a banner that says, here are all the acronyms.
Put it here.
Yes. So claims without conveyance of title.
Yep.
And then Commissioner Adjusted Fair Market Value.
There's a lot of them.
Yeah, and MMIF, Mortgage Mutual Insurance Fund. Mm-hmm. So as we're doing all these acronyms, has it affected it? So in the past, it's been a really excellent tool to take the value of the property and get it to a third party, hopefully at the highest value appropriate, because we've had this valuation done, this appraisal done. We know the value. And essentially the value should be setting what the market is interested. Are there variables? Something might be a little more interest if somebody's local and they know the area, or I don't know, a family member is interested in the property, so they're willing to go up to a certain amount. There's always those outliers, but in general, the value determines what people are willing to come in at. And most people are looking to grab a little bit of a deal. So those haircuts to the already established appraisal value would allow you to entice people to come in.
Right.
Under this new version, there's by not taking the lesser of, like if we did the lesser of, there's possible margin to work with for either an institutional buyer or homeowners to work with, people who are coming in to want to buy directly via that route. So I would say, some people might say you're lessening the juice in the squeeze by going with the higher number. So anytime you lessen the juice in the squeeze, you're going to have a different market response. And I would say right now, the market, we can certainly have anybody that runs an REO shop. I do. I've seen a softening response lately. I've even read a few articles out of your all's group that say, hey, maybe there are some softening markets, and we are seeing that as well. So I would say softening markets with higher bids would show less interest. There's a little less margin to work with there.
So looking from just a logistical standpoint, as far as day-to-day how you're dealing with this, are there impacts you're seeing at Carrington specifically, or that you've heard from other industry contacts, as far as how is this impacting what you do on a day-to-day basis? I
think industry-wide, we're seeing different impacts as we're waiting and working out what to do. There's some, at least, conjecture that there are some mortgagee letters that before the shutdown would have been issued and made some changes or clarifications that would have allowed us to maybe all move forward in the exact way that HUD has intended. Being as we have the shutdown, we're waiting for those to come out. And, that will certainly inform everybody's decisions. Everybody has to act within their own understanding and feedback from their legal groups and their compliance groups, and of course with what we already have from HUD previously through things like audits and OIG reports and anything in conjunction with something that would have guided your policy in the past. Mm-hmm. So I think what we're seeing is there's some methods where people are saying, hey, you know what? Let's put it on hold, even if that means a curtailment, and let's see if we can't get the homeowner engaged. Because if there is equity, if there's this margin available, maybe we can get them on the phone for something more like a traditional sale, because hopefully there is really equity. We bring up the question about, sometimes appraisers don't hit the market exactly right. And though the value may be there on paper, we do not find it there at the bidding function. So then you have to wonder, is there, it may be on paper, but is the market there currently matching what the paper's matching?
Well, that leads perfectly into my next question. So given that this is supposed to set the bid level for the CWCOT properties, what does the conversation or the process look like of evaluating whether that's in line with the reality on the street of what's actually out there? Is it just about these industry conversations and interacting with HUD, or what does that look like? I
think there's 2 or 3 spots, and of course everybody that's ever done REO says this. It's very specifically market driven, right? And
Sure.
local, local. You've got to be hyper local. Take that a little more out of the equation. We always want to trust an FHA appraiser that they're doing an FHA appraisal in accordance with all the rules and certifications and understanding. So we get to kind of take that one out of too. We want that to be known. I will say that there's an aspect here that sometimes we run into, which is a lot of these are occupied. So the appraisals are going to be accurate to the effect of being accurate on an exterior only appraisal.
Right.
And the interior, after going through a default, can sometimes vary widely. So I think that throws a little mystery into the question, and also the changing market. Again, since it is hyperlocal, is this market seeing the ability to? Is this home going to be hot no matter what it looks like inside, or is this home, even if it's great inside, is it still experiences the softening market? So. I would say we want to be able to look at our history and hope it informs the future, which is what we believe HUD tries to do. Mm-hmm. With they give us what is essentially possible haircuts in ways. They also have negative haircuts in markets that they don't feel are softening. So as we see these changes, I would say the only concern there might be is, does HUD possibly have enough information? Because it's not every sale, right? They're using HUD comparables,
right,
which would be a much smaller market segment to make decisions like that on. So I think that those are more of where we see the variables of, is this really the right way to do it?
Is that more complicated in markets where property values may have stagnated or declined? And does that make it more challenging to reconcile the CAFMV, however we want to say it, plus any of those discounts or haircuts with what the actual investor appetite or buyer appetite is in a given place? So
I think for me, what we'll see take place, let's say that these new mortgagee letters or clarifications really help us all move in the exact direction that HUD wants to go for the future of the program. And through that, let's say that it stays exactly as it is as they understand it today. Well, I would hope that the changes would come more frequently, more like REO groups have to do maybe every 2 weeks, mm-hmm. maybe every month,
right.
Assessments on what's the pull-through look like, what's actually making it to closing, why are contracts falling through, mm-hmm. that kind of thing. I would hope it would get to something that heavy, but I'm not sure that kind of heavy hand is going to be able to be used with this program. So, in general, I think we all were hoping it would continue to work, at least as an industry as a whole. We feel like it was working very well for the past 9 or 10 years, and meeting its intended goals. So if the goals have changed, maybe we just need to know the goals have changed.
What is the process like when you're having these conversations within the industry where there seems to be a disconnect between those numbers and what the reality is on the street? Is there an appeals process for that? What do those lines of communication look like? Is it about conversations that you're having with those officials, in meetings or at conferences? What does that look like?
We've got a lot of people that have a lot of data, and I think we hear a lot from them even on this podcast, right? We got a lot of people that have things like pull-through rate and rate reduction and time on market and which markets are doing well, which markets aren't. And I think that listening to those people, making sure we have the open conversation channels, and again, understanding the intent of the programs. If the intent of the program is to encourage third-party buyers, pay less on claims, and reduce REO inventory, well then, are we showing that our numbers are meeting those goals? Can we help HUD show that they're meeting those goals? That's what we would want to do with those numbers. If we show that it's not meeting those goals, perhaps, what if the new goal is to make sure that the MMIF is not being affected by partial claims going unpaid with homes that have equity, and they believe that that's a large percentage of their value book coming in? Well, then we would just need to make sure that the goals change so we can measure against those new goals.
That makes sense. Do you run into situations where the commissioner's fair market value seems to be discouraging bidding, whether that could be increasing holding times or maintenance costs or the risk of actual conveyance to FHA instead of going to a third-party sale? Do you see that happening?
I'm not going to say that CAFMV itself affects that. What I will say is that by, again, as we already talked about, by going for the higher of, you're reducing possible margin or savings for those interested, whether they be small institutional, large institutional, or individual home buyers. When people are coming to it and you say, well, the house is worth $100,000. And they go, well, I don't want to pay $100 for it. And you're going, well, I've got $100. My total debt's only $80. But I want you to pay that $100. You're reducing. You possibly could have come in at $80 and then found a buyer. So I think it lessens the pool just a little bit. It would probably put you in a position of needing properties that were in a hot market to be able to continue to have that kind of higher pull through. And where they aren't in a hot market, what's going to happen is they're going to end up going through the conveyance process instead of being taken through the CWCOT.
I'm curious, just we sort of touched on this a little bit, but how familiar are homeowners that you're working with all of these programs? And is there a big education gap, or what is that like working with them and trying to explain that there's this thing you can do that is an option for you, and here's a bunch of acronyms?
I would say that this would be for a slightly. I find that the people involved in taking a home at foreclosure sale or at what we would call a second chance sale for HUD properties are for people that are a little more educated with a default foreclosure process.
Right.
Because I'm not sure if I asked my mom and dad that they would know that they could go to a foreclosure sale and bid on a property. Also, it comes with its own set of concerns, whether you're cash or financing and things like that. Not all financing works with. So I think it really depends on, I think it requires a slightly higher education level in how this process works. But there are people, particularly in the second chance sales, they see a property, they want it. It's next door. It's next door. And you're just like, I want this. How do I get this? Well, there's a number in the window. You call that number and you say, I want this property. They eventually get you over to the REO department. And the REO department says, well, it's a HUD property. So we're either going to give it to HUD or we are currently accepting bids. And here's somebody that can help you with that.
Yeah.
So I would say if the totally uninitiated would probably stumble onto this process by following the trail. people who are actively involved, which is why it tends to be small institutional instead of the large institutional. People with, I think auction.com at one point said investors with 10 or less properties in a local market. They tend to be very interested in what the foreclosure or second chance might be able to provide.
What sort of feedback do you get from investors or bidders when it comes to transparency, predictability, consistency even of the value across the different markets, across the different regions?
I think everybody hopes that they figured out the algorithm.
Yeah.
We don't know it. We get the updates from HUD regularly, and anybody that runs their own REO shop is going to have the methods for when they maintain or decrease or time on market that assesses this. Or some people are just, it will always be in a hold, right? Like we're staying here at the value, and some people have reduction strategies and some people have rehab strategies. So I think it really depends on what you're going. But I think a lot of people on the outside looking in, they're looking at it going, I think I understand HUD's strategy, and if I wait a few more days, maybe it goes down a little bit. I would say we just wait for the adjustments to come and act on the adjustments. I don't pretend to understand or know how or why HUD wants to do their algorithm. They're taking their data that they have to make the decisions that they need to make based on the local markets.
Well, I know you work with a couple of our groups, and you're working with the Property Preservation Executive Forum. I know you've worked with MCN and NIMSA and some of those other groups.
Lots of acronyms today.
I know we've got a lot of them. We'll put it up on the imaginary screen here next to me. Are there enhancements or changes to this methodology, which you may or may not understand entirely, but are there changes that you would like to advocate for that you guys think would be helpful, as far as whether it's how things are calculated or just how things are communicated? And I know you said there may be some mortgagee letters coming out that will clarify that.
I might have different opinions after the mortgagee letters come out, but currently I think if I were asking for anything or asking on behalf of our industry understanding, I would be saying, let's make sure that we understand the goals. And we have opinions on why we think the program's working, like choosing the lesser of. There's an opportunity that maybe this program is voluntary instead of mandatory if it needs to work another way. So there are some opportunities for us to get some clarification and come to a better understanding about what needs to be met and done. When it comes to things like pricing, I would just say understanding where the data is coming from, and if the industry can do anything to further help get more data, which would make for hyperlocal decisions, more frequent decisions, and better decisions, which allow more people to come to the market, particularly if we can ever find the secret sauce that gets more owner occupants in. There's definitely great things about the program, like first look and things like that. There's this opportunity for people who are going to be in the home to have this kind of first opportunity. But again, you kind of have to stumble on to these homes in the first place or be very educated to know that you can go do these things and work with some of the untraditional ways that you would have to get to them. So if there was, a better marketing strategy for getting people who just are in a normal home buying process to go consider one of these homes.
Right.
That was probably, a better way of doing some of the things that we would really want to do, which is getting homeowners into those homes immediately, instead of maybe having the possible small institutional investors that tend to do a little bit of rehab and get people into the homes just, a little bit later than that.
Well, I know we're coming up on the end of our time, but I want to broaden, just to close out a little bit. We've talked a lot about this very narrow focus of this segment of the market, but I know you are someone who is always head down reading the mortgagee letters. I know you're staying on top of all this stuff.
Bedtime stories for the kids.
Absolutely. I'm sure it works very well.
Works for me sometimes.
That's right. Looking ahead to the new year coming up, from a servicer's perspective, are there a top 2 or 3 headwinds that you're really watching, things that you're focused on going into this new year of like, these are the problems we need to solve, this is what we need to address?
CAFMV, the clarification or understanding on that in a major way, which we hope to get through the mortgagee letters that are waiting to be published. There's been some chat around a possible also clarification needed on data default, what I would call static versus dynamic data default.
Right.
And that is a headwind if we don't fully understand what's happening there. There's been some FAQs that have been released that have maybe a different understanding, looking for words like include or only include. Like those.
Very important.
Those are very important words. So you look at some FAQs, which we don't always know if they're published. You have to go find them, and then you have to look at that and go, is this a policy change? Is it not? As of at least yesterday, there's at least property, you were talking property preservation, there's a contracting lapse that hopefully maybe tomorrow, by the time you're editing this, won't exist.
Yeah.
But at least as of today, it's a concern.
Yeah. Well, awesome. Well, thank you for sitting here and speaking with us, Candace. We always enjoy having you at our conferences and working with you. So thanks for everybody for tuning in to MP Access Podcast. We've been talking to Candace Russell from Carrington. Thank you, Candace.
Thanks.